Welcome to this explainer. Okay, let's just dive right into this because we really need to confront a hard, frankly counterintuitive truth about your financial habits today. You've probably been doing everything right. You've got the high-yield savings account, you've relentlessly cut your subscriptions, you put money away every single month without fail, and you feel genuinely proud of your savings balance. And honestly, you should. But there is a silent leak in your financial life right now that is absolutely massive, and it's happening right under your nose.
$302,000. That is the exact amount of money a perfectly disciplined saver loses over 30 years simply by keeping their money in the wrong account. And the crazy reason this number never triggers a fraud alert from your bank is that it's not money you actively lose in a market crash or to hidden fees. It's money you never make in the first place. And those are two very different things. One feels like a total crisis, while the other, well, that just feels like a normal Tuesday.
Before we really get into the data, I want you to do a quick mental self-audit. Right now, don't go look it up, just estimate. What is the ratio of your savings account balance to your investment account balance? For the vast majority of people, that savings balance is going to be bigger. And by the time we finish this explainer, you're going to understand exactly why that ratio is arguably the single most important number in your financial life and why having a larger savings balance might actually mean you are currently trapped.
Section 1. The Savings Trap, where $4.8 trillion sits completely idle.
Let's look at the undeniable math behind that massive mountain of cash currently held by Americans in traditional savings and money market deposits. Historically, the S&P 500 averages roughly 10.5% annually, right? Compare that to maybe a 4.5% high-yield savings account. Let's take two 30-year-olds. Both start with 20 grand. Both meticulously save $500 a month for 35 years. Person A puts it in that high-yield savings account and finishes with a really impressive $620,000. But person B puts that exact same money into a simple S&P 500 index fund. Person B finishes with roughly $1.97 million. They had the exact same discipline. The only variable was the account choice, and it resulted in a staggering $1.3 million difference.
Now, you might be looking at this and thinking, yeah, but savings accounts are safe. Let's reframe that illusion of safety for a second. If your high-yield savings account pays 4.5%, but inflation is running at, say, 3%, your real return is only 1.5%. You are literally barely treading water. Over a decade, that pile of money you're so incredibly proud of actually loses its purchasing power. Guaranteed underperformance of inflation isn't safety, it's the active destruction of your money's value.
Section 2. The Psychology Block, why we avoid investing.
So if the math is so incredibly obvious, why on earth is $4.8 trillion still just sitting there in underperforming savings accounts? Well, it all comes down to loss aversion. This is a brilliant behavioral economics concept formalized by Kahneman and Tversky, and it basically shows that our human brains are wired so that the pain of losing a dollar feels roughly twice as intense as the pleasure of gaining one. A savings account feels so safe because the number on the screen never goes down. An investment account fluctuates, which your brain incorrectly flags as a mortal threat, making you hesitate or just avoid investing altogether.
And let me tell you, this hesitation is incredibly expensive. Vanguard actually looked at millions of their customers and found that the average person waits 18 months from the time they seriously consider investing to the time they actually pull the trigger and open an account. That 18-month delay, it costs the average person approximately $9,100 in missed contributions and compounding. The savings trap isn't just the difference in return rates, it's the steep cost of the time you spend overthinking it without acting.
So, the absolutely crucial point here is how the most successful people view this dynamic. The top 1% of American wealth holders keep less than 2% of their net worth in savings. That's right, the people with the absolute most money keep the least proportion of it in savings, totally flipping conventional wisdom on its head. They just don't experience money the way a typical saver does. They rely on entirely different mechanisms.
Section 3. The 3 engines of wealth and how to actually build it.
If saving isn't the answer, what the heck is? Engine number 1 is invested assets that compound. We're talking about broad index funds where your returns go on to generate their own returns. And here is a truly mind-blowing fact. The S&P 500 has never, not once, failed to outperform a savings account over any 20-year rolling period in history. Not through the Great Depression, not through the 2008 crash. Give it 20 years and compounding becomes virtually unstoppable.
Engine number 2 is appreciating assets. This one is all about leveraging scale. Real estate is obviously the classic example here. You leverage a down payment to participate in the overall appreciation of the entire asset. This engine perfectly explains the massive wealth gap we see between median homeowners, who sit at around $396,000 in net worth, compared to renters at roughly $10,400.
And engine number 3 is the raw material, an income that clearly exceeds your lifestyle. Because let's be real, you cannot invest what you spend. The gap between what you make and what you spend is the ultimate fuel for those first 2 engines. The highest return investment you can possibly make, if you don't already have this gap, is in your own earning power, because you absolutely need that excess capital to build real wealth.
Now, before you go and liquidate your entire savings account to throw it all in the market today, let me inject a little urgency into why you actually still need some cash on hand. Fidelity's data shows that people who had to liquidate their investments during the 2020 market crash just to cover emergencies locked in an average loss of $34,000. 34 grand. This proves exactly why a baseline of emergency cash is absolutely mandatory.
So here is your definitive cash framework. I want you to think of your emergency fund exactly like a fire extinguisher. You absolutely need one. You keep 3 to 6 months of living expenses in a high-yield savings account for pure resilience. But listen to me, you do not furnish your entire house with fire extinguishers. That would look totally ridiculous, and financially speaking, it is. Anything beyond that baseline and any money not meant for a specific short-term purchase within the next 3 years needs to be put to work.
Let's make this payoff incredibly concrete for you. If you have just $15,000 of excess cash sitting in a high-yield savings account right now, completely beyond your emergency needs, moving it into a total market index fund today can become approximately $161,000 by the time a 30-year-old reaches retirement. One simple decision, $161,000 payout.
Section 4. Removing decision friction and overcoming resistance.
Remember, procrastinating for just 6 months can cost the average person $22,000 in lost compounding over a lifetime. To completely bypass that hesitation, starting tonight, here are 3 frictionless steps. First, automate your transfers the day after payday so you never even feel the money leave your checking. Second, start embarrassingly small. Literally, even $50 a month, just to build the identity of an active investor. And third, check your accounts quarterly, not daily, to totally bypass the emotional triggers of loss aversion.
And that last step, it is backed by some serious hard data. A really famous study by Benartzi and Thaler proved that investors who check their portfolios monthly actually earn dramatically lower long-term returns than those who just check annually. Basically, more information leads to worse emotional decisions. Looking at your account less is quite literally highly profitable.
Section 5. The identity shift. Saver versus owner.
The gap between where you currently are and where you want to be is ultimately dictated by your financial identity. Take a look at the Dalbar Institute data from 2023. The market returned 26%, but the average investor only saw a 21% return. That 5% behavioral gap is entirely due to emotional decisions. Acting on those super careful, fearful saver instincts literally cost people tens of thousands of dollars during their investing lifetime.
We need to shift your identity from being the saver to being the owner. Think about it. A saver's primary goal is just to not lose money, so they effectively act as a lender to a bank. An owner's goal is to build wealth. When you buy broad index funds, you own a tiny piece of thousands of wildly successful companies. You literally own shares of the economy itself. This shift changes your core question from, is this safe, to, is this building something?
And that brings us perfectly full circle to close the loop on where we started today. If you take $22,000 and keep it in a high-yield savings account for 30 years, it grows to about $82,000. But as an owner, putting that exact same 22 grand into an index fund at 10%, it becomes $384,000. The initial money is perfectly identical, but the account changes the whole shebang. That right there is exactly where your massive $302,000 gap comes from.
So, I'm going to leave you with this final provocative thought. Is your financial identity costing you an absolute fortune? Please do not wait on this. Make the shift tonight. Actually, I want you to drop a comment below right now and tell me, what is your savings to investment ratio looking like today? And hey, if you want to know exactly which account to put that money into next, you definitely won't want to miss our next explainer, where we're going to break down the specific tax-free accounts that are quietly minting millionaires completely out of the IRS's reach. I will see you there.